If you're an S-Corp contractor paying yourself $40,000 on $400,000 of net income, I've got some bad news for you. You're not being smart and you're setting yourself up to be audited and you just don't know it yet. My name is Artem. I'm a CPA, managing partner here at Torrent Accounting. We love working with contractors and the construction-related industries. We live and breathe this stuff. Come check us out. I also love kettlebells. So if you're here for tax advice or to work on your kettlebell form, welcome. You're gonna love this video. Please like and subscribe. How much should a contractor actually pay themselves? We'll be discussing the S-Corp trap today. So most contractors either pay themselves too little or too much. In either case, that has negative tax consequences and misses the whole point of the S corporation. The S corporation was designed to save you taxes, but the wrong salary undoes this entire strategy. And there is a sweet spot, and it's not a guess. I promise you. You can figure this out and get yourself on the right track. So let's go. Let's start off with the quick refresher of why an S corporation is, how it's actually designed and how it's designed, or how it can be utilized to save you on taxes legally. So, quick refreshes. If you've seen some of my other videos, shame on you if you haven't. You can go back and watch them. They're still live on YouTube. Just kidding about the shame. I'll cover it here. Is when you are in business and you're self-employed, single member LLC, filing a sole proprietor Schedule C with the IRS. Without any other election, you would be subject to federal income tax that we all know and have come to love, and self-employment taxes. There are some phases out with them, but those self-employment taxes, not adjusting for the phase outs, are an additional 15.3% on top of the federal income tax. So tax rate can get pretty high pretty quick if this strategy is not implemented correctly. So what does the S-Corp does? It splits your earnings into two categories. Your salary, which will be subject to federal income tax and the self-employment tax, and then your profit distributions, or your distributions as a shareholder, which in theory, if done correctly, should only be subjected to the federal income tax and not capital gains, which if you don't do it right, is a possibility. We're gonna teach you how to do it right. Come talk to us or watch this video. We're not gonna get into the capital gain stuff actually on here, but we're gonna talk into your W-2 income and your distributions. So if you're thinking about it, you're probably thinking to yourself, why wouldn't I take all of my income as a profit distribution from the S corporation? Why would I pay myself any kind of salary? Well, because the IRS requires you to, and the IRS requires you to have a reasonable salary for your line of work as the officer of that corporation, as the shareholder. So with that, let's get into it a little bit further. The lower your salary, as I mentioned, the more you save, but the IRS requires reasonable compensation. This is a top audit trigger for an S corporation, and you want to make sure you're set up correctly so that you're not setting yourself up for failure down the road. What does reasonable compensation actually means? So the IRS looks at your role, your hours, the market where you're operating in, and what you'd have to pay somebody else to do your job for you. So for a working contractor, let's say you're in the field, right? And you're between $500,000 and $2 million of revenue. You're likely doing a lot of field work. You're running your crew, you're hands-on. So your salary has to be reflected both on the field work and the management work that you're doing for your owner duties and for the company. So a solid framework to start off with to figure out what your reasonable salary should be is figure out what a foreman or project manager in your market that's very important makes. That's your floor, so that's the bottom you should be paying for yourself. And then you want to add a premium on top of that salary for yourself, for your owner duties and the management work that you're doing in office. And use real comp data. There's industry surveys available, there's some softwares you can run it through. Don't pick a round number just because it feels right. So I mentioned your market is important, and it is, right? So we are in beautiful Jackson Hole, Wyoming, where the compensation market is, from our experience, tends to be higher than the national average of what jobs pay. So if you're a contractor in the Jackson Hole area, your salary might need to be higher than, say, if you're in Salt Lake or a more competitive market where there's more competition and the salary is just naturally suppressed because of that. Not always the case, but market is an important thing. And then you want to look at industry surveys, like I mentioned. And if you're in Jackson Hole, fun fact, only for those that aren't living in the Jackson Hole area, is we still use newspapers here. We sure do. You're not going to believe it. Nobody believes it when they first move here, but if you want to find a job here in Jackson Hole, is you get the local paper and you go to the Help Wanted section. I swear, that's true. But if you go to any job searching website, you're gonna find far less jobs than you will in the newspaper. So that's how we do it here. So you can even take a newspaper article, figure out what the foreman makes. That's your floor, right? You wanna document it. At 500,000 to 2 million in revenue, your salary is often the biggest piece, or it should be, in terms of your compensation and how you split that income in your S corporation, because you're still in the trucks, you're on the jobs, and you're running ops, right? As you get over the 2 million, sometimes at 2 million, sometimes at 3 million, up to the 20, you've likely got a team. So you got an office team, you have an accounting team, you got a management team. And so you can start paying yourself less as a salary, the more your duties scale back and you're not actually in the field as much. And more profit can come through distributions. You want to document your methodology in writing every year. If you ever get audited, whatever your methodology is, whether it's top of the line or kind of inadequate, you want to bring that with you to the audit and have something to present to them. Now, the IRS might disagree with how you got to that number, but at least you have a starting point of how you got there, and they're gonna know you're not guessing. And with the IRS, it's just, it's always better to be prepared and have something to present than nothing. Because if you just pick, well, I picked $40,000 because I didn't want to pay self-employment tax on my distributions, it's not gonna go well. And what they can do, and this is what we're trying to avoid, is they can go back and reassess your distributions as salary, and then you owe penalties and back payroll taxes, and it becomes a real mess real quick. So do it right the first time. If you haven't been doing it right, it's okay. We're here for you. We'll help you with that. We'll help you with your kettlebell form. And again, my name's Artem. Please like and subscribe, drop us a comment. What other topics keep you up at night with taxes, kettlebells, Olympic lifting, your choice. And we'll sure to get to them. Thanks, see you on the next one.